Hey everybody, today I want to talk about the fourth return on investment properties, and it's our favorite subject, depreciation. So I'm going to try and break it down in an understandable format. So just to review, your first return on real estate is your cash on cash. So let's say, for example, you have $2,500 coming in rental income and your payment is $2,000. Then you have $500 of cash on cash return. So you divide that into the amount that you put down to figure out your return there. The second is appreciation. So you take whatever your purchase price is or your value of the property, and if that goes up 5%, then that value goes up. Once again, you can divide that growth into the amount that you put down. That's your second return on investment. The third is your principal pay down. So back to that original scenario, if you had $2,500 in rent, but your payment is $2,000 a month, well, within that payment, about $400 of that is going to be going towards principal, and the tenant is paying that, and so that becomes, that principal pay down increases your net worth, and so you add that up over the year of that principal pay down. Because you didn't pay it, divide that into the amount that you put down, and that becomes your third return on real estate. So the fourth one that nobody ever really talks about is depreciation. So I want to try and tackle this. As I start this discussion, I want to start right up front. I'm going to work in general principles, and that's important to note. This is part of the IRS tax code. It is technical, a little bit complex, so that's why I'm going to try and break it into some generalities. All my smart accountant friends and financial advisors realize I'm not trying to get it right down to the penny here. I'm trying to teach the principle of depreciation. We would invite you to talk to a licensed tax advisor. Your situation will be unique, and then you can get very specific into what benefits might be there for you. So let's go after depreciation. So to start that, I'm going to go and just show an example of where I'm starting. So I've used a household income of $250,000. Now, at that, for a married filing jointly, you would actually be at a 24% federal tax bracket, but you don't pay 24% on that total amount. It's tiered up on a marginal rate, and so on average, it's going to be roughly about 16% of your total income that you would have paid in federal income tax, or $40,000 on your $250,000 you made in federal income tax. The second, I'm just going to use the state of Utah. Tax rate is 5%. You would take 5% into that adjusted gross income of $250,000, or that would break down to $12,500. So when you add your federal and your state income taxes, that comes up to $52,500 in total income taxes paid that year, or about $4,375 a month in income taxes. So that's pretty significant. Now, to teach the principle, I'm going to come over here to depreciation, and I'm going to start with an example of just a single family residence or a townhome type property. Commercial real estate is handled a little bit different, so I'm just going to talk about residential today. Let's say it's a $500,000 total price, the IRS will back off the value of the land. So let's say that that's $100,000. That leaves us with a $400,000 cost for the structure. Now, the IRS, knowing that over time that property is going to deteriorate and you're going to have to replace different components of that property, allows you to take a deduction currently to generate more cash flow for you, knowing that that is going to have to take place over time. So on a residential property, they're going to take that $400,000 on your structure cost. That is depreciated over a 27.5 year period. And so what you'll do is you'll take that $400,000 structure cost divided by the 27.5 years, which gives you an annual depreciation deduction of $14,545, or about $1,212 per month in deduction. So as how a deduction works is you would take that $15,545, and now I put a side-by-side back up here. If you took the $250,000 household income that family had made and deduct the $14,545, that lowers the adjusted gross income down to $235,545. I'm still just going to use that average tax rate of 16%, so that would have lowered their federal income tax bill to $37,687. The Utah state income tax at 5% would have dropped down to $11,077. So adding the two together in total would have lowered their tax bill down to $49,464 for the year. So looking at what it was without the deduction from the depreciation, they would have paid $52,500. With the depreciation, that lowers that down. So the total annual difference is a savings of a little over $3,000 for the year that they got to pay in less in income taxes, which becomes money that they can spend on investing in other things. They can use it for whatever that they would like. Now, so that's general depreciation. Now I'm going to come over here and hit on a principle of cost segregation. So it allows you to get additional depreciation and speed that up. So to our original scenario, if you had a $500,000 total price, your land value is still at $100,000 and your structure cost at $400,000. Well, is what a cost segregation does is it knowing the IRS knows that different components in that structure are going to wear out faster. And so they allow a third-party auditor to come in and do this assessment. I'm not going to get into the details of which one qualifies on which one. I just want to teach the principle here. So let's say that for example, that we have, oops, let me fix that real quick. Let's say that it was light bulbs and carpet, for example, on a 3-year depreciation. They'll take, and that adds up to $40,000. They'll allow you to take that and now depreciate over 3 years rather than 27.5. So dividing that $40,000 by the 3-year gives you your first year depreciation of $13,333, and then you'll get that amount that you can depreciate for the next 3 years over that period. Your 5-year depreciation, I just used a number of $25,000 for the components that may fit into that category. So once again, the $25,000 divided by your 5 years is $5,000 a year for that 5-year period. You're getting the idea. There's also a 7 and a 15-year bucket that you can do. And so when you add all that up, so if I take the $40,000, the $25,000, the $45,000, the $20,000 that we have segregated out, that leaves us with the remaining $270,000, which is probably going to be a lot of your structure, your shell of the property. And that remaining piece, then you use your normal 27.5-year depreciation schedule. So you divide the 270 by 27.5, which gives you 98.18 in annual deduction for the 27.5 years. Now, the difference here is that you would add all of these up, giving you a total of $35,912 in annual depreciation deduction. So that becomes significant because what that is going to do is that is going to change our gross income over here. Once again, from the $250,000 that you would have claimed without that deduction, that's going to lower that down to $214,088. And now we see how that changes the scenario. So now the income's down. I'm still just going to use that 16% average tax rate, which would lower those federal income taxes down to $34,254. Your state at the 5% down. So total taxes paid dropped from $52,500 to $44,958 in income taxes, or $7,542 in additional tax refund or taxes not needing to be paid that year. That's $628 a month. That becomes significant in my mind, and that becomes your fourth return on real estate, because you can take that money now and you can take that $7,500, divide that into the money that you put down, because without investing in real estate, you would not have been able to achieve that deduction. And so that is your fourth return. And we put all four of those together. It's pretty remarkable what real estate can do as an investment tool, not only for just actual cash on cash returns, but in benefiting you on a tax standpoint. One thing I want to note, just a couple of points. There are differences in how you deduct this, whether it's passive or non-passive, and that's why I recommend that you get with a licensed CPA for your specific situation. To do the cost segregation, if that's something that you want to consider, give us a call. We have lots of great firms that can do that. It's third-party audit. They will do a free consultation to kind of review your taxes and the property, to get a quick idea on what you might be able to get as additional cost segregation benefit, and whether that is helpful to you or not. One of the other considerations on depreciation is that you do need to recapture what you deducted when you sell the property back as income. And so Once again, that's something that the third-party auditors from the cost segregation side and your CPA will help you walk through and determine, does it make sense for us to accelerate the depreciation if we're going to have to pay it back if we're going to sell it in a year or 2 years? That will be unique to your particular situation. But it's very powerful. If you have never used a cost segregation, it's another tool that you can go back and, for example, amend your last 3 years worth of tax returns if you wanted to do that, and have that cost segregation done. Go back and adjust and get a ton more back in tax refund from that. That could create the next down payment for you on an additional investment property, and provide you more opportunities. So I hope that is helpful. Once again, I just reiterate, it's important that you talk to a tax advisor. I have talked in generalities today just to try and help illustrate how the concept of depreciation works. But feel free to call us. We'd love to walk you through and answer any questions you might have, just in general about your ability to achieve the goal of passive income from an investment property. So I hope that explanation helps, and share this video with anybody that you know is trying to learn about this concept.